Hello, everyone, and welcome to the second half of the Chapter 11 sample problems. Hopefully you have watched all of the lecture videos, so you're ready for this. In problem number 4, we are dealing with a warranty liability problem. So warranties are an example of a contingent liability where we record what we estimate will be our payments for the liability. So we have O'Connor Company, and they guarantee their vacuums for 4 years. Prior experience indicates that warranty costs will be approximately 6% of their sales. And we're assuming that O'Connor made sales totaling $200,000 during 2024. Now, we're going to record our warranty expense for the year. Now, because we have an amount that we feel is probable that we will incur for this, which is the 6% of sales, and we can estimate it, we are going to record it at the same time as the sales so that we are following that matching principle of matching expenses with the revenues that they're associated with. So for our $200,000 worth of sales, we're going to multiply that times 0.06 or 6%. That gets us to $12,000. So that is the amount of the warranty expense that we are going to record. So for our warranty expense, we're going to debit warranty expense, and then we are going to credit estimated warranty payable. Now, noting here, by the way, that we are recording expense now. So in this case, when we pay out for warranties or we refund them for something, we would want to apply it against the payable, not record additional warranty expense. So keep that in mind that when you pay out for a warranty, whether it's cash or replacement goods, you're going to want to debit estimated warranty payable and then to relieve that liability, and then credit either cash or merchandise inventory, whichever you use to pay for that. So, so here we are going to accrue our warranty payable. Okay, so next is a question that's asking a little bit more about contingent liabilities here. So what do we do for these different types of situations for liabilities that might occur? All right. So if we have something, it's like, oh, it could possibly happen, but it's very remote likelihood, then we would not report anything, and we would not we would not need to disclose anything in the notes to our financial statements for something that is remote. Okay. Now, if something is reasonably possible, but not necessarily probable or likely, then we would just describe it in the notes to our financial statements. All right. Now, the next level up, if something is likely to occur, so it's probable, but we don't know how much it's going to be, like we have no idea how much that's going to be, then again, we would just describe the situation in the note to the financial statements. Because as I mentioned earlier, it has to be both probable and we have to be able to estimate the amount. Okay. Now, in the event that it is probable and we can estimate the amount, just like in our warranty example we just did, then we would record an expense and a related liability based on whatever amount we estimated for that liability. Okay. Now, our next problem is looking at a financial statement ratio that is associated with payments of interest and liabilities, and it's called the times interest earned ratio. So how many times are we able to pay off the interest that we owe on our debt during a year in comparison to our net income before interest and taxes? Okay, so we're going to take our net income, our bottom line net income, we're going to add back our income tax expense and our interest expense. We're going to take that total amount and we're going to divide it by our interest expense. And that's how many times can we pay for this interest expense using our net income before taxes and interest. So looking at this, we've got net income of $19,300. We have income tax expense of $5,800, and we have interest expense of $900. We're going to add those together, first of all. So that is our net income before interest and taxes, right? So $26,000. We're going to take that and we're going to divide by our interest expense, which is $900. And that gets us a times interest earned of 28.89 because they want us to round it to 2 digits here. That means that with the amount of income we're making, we could afford to pay just the interest on our debts 28.89 times. All right, and obviously, the more times you can pay off that interest based on that ratio, the better able to service debt your company is. And so that's a metric that's used by lenders sometimes to see how heavily loaded down you are with debt in comparison to your income. All right. Next problem is just another review example going through a note payable. So another example here, we'll take a look at this here. So we're purchasing some equipment costing $16,000 by issuing a 1-year 9% note. All right, so I'm going to put this down here. So to record the initial transaction of the equipment purchase, we're going to debit equipment and we are going to credit note payable since we are not paying for that with cash. And that is $16,000. So purchasing equipment in exchange for a 1-year 9% note. All right, now the next entry we need to do is to accrue interest here, right? So we purchased this on August 1st. So that means we're going to have August, September, October, November, and December here that we have to record interest for, right? So 5 months, 1, 2, 3, 4, 5. So just like in the previous example, we need to take our principal, our annual, our APR or annual rate, and a time factor. And so to record interest as of the end of the year at December 31st, we need to accrue that, right? So 16,000, 9%, and a time factor, which is going to be 5 months out of 12 months. So then that gives us interest to accrue equals C10 times C11 times C12 of $600 that we need to record. So we're going to debit our interest expense for the $600, and we're going to credit interest payable. So we are not paying it right now, we're just accruing it, okay? So recording interest, accruing interest expense at year end. And we are payable, by the way, don't mix up and hit receivable. And then on August 1st of the following year, so this was a 1-year note, right? So total 1-year note. We've already recorded 5 months of interest. We need to expense the remaining 7 months of interest, okay? So that is what we recorded at the beginning. I'm just going to grab this and copy and paste it right down here. And then I'm going to calculate this for the remaining 7/12 instead. So that means that we are going to record an additional $840 worth of interest. But what we're going to do when we pay off the note, we have to debit the note payable to zero that out. So the initial note was $16,000. So we're zeroing that out. We need to zero out our interest payable we already recorded for $600. We need to record our additional interest expense, which is going to be a debit for the 840 we just calculated. And so that means our total payment is going to be 16,000 plus the 600 we owed from before, plus the additional 840 we owe now, for 17,440. So that is to pay note and interest at maturity. Oops. Oh, I forgot to put cash. Make sure you put your accounts in there, people. There we go. All right, so that is just that follow-up second example for notes payable. Hopefully that helps you out with chapter 11.